You need a stand-in monitor?
You think you can do it?
Yeah, I'll give it my best shot. Get it started.
Okay, I'm going to be a stand-in monitor. And these are our guests, Christopher Millard.
Right here.
Peter Bures.
Bures, right here.
Bures. And James Russo, Metals Mint.
How you doing?
So, how to go for gold? Who would like to go first?
Peter.
Well, there are several options that people have in terms of investing in precious metals, not just gold, but silver as well. One of them is through buying physical, that's Jim's specialty, and another one is buying various companies that are involved in the extraction of precious metals, and as well as ETFs that are made up of these precious metals companies, and that's Chris's specialty. So, Chris, if you want to start us off a little bit, tell us about ETFs and precious metals companies. And wait, before you do, I'm sorry to interrupt, before you do, another way to invest as well is through royalty companies, and I'll be talking about those. But Chris, please take it away.
Okay, so yeah, three different types of things going on here. One is physical, one is royalties, and one is companies, which is mine. So basically, gold funds started in 1956 with Van Eck. Right, it's the first gold fund in the world. There's now 114 managed gold funds in the world with $28 billion. Biggest one is BlackRock, managed out of Luxembourg, or domiciled Luxembourg. It's managed out of London. And if you look at those funds, 55% of the money is invested in Canada, 15% in Australia, and 8% in the US. So Canada is the market for gold companies, publicly listed gold companies. Now in 2004, a new market started, which is ETFs. And now today, there's 220 ETFs, metal and mining ETFs worldwide, and they have assets of $350 billion, so more than 10 times, about 15 times the amount of money is in ETFs. And they've sucked all the money out of the gold funds and out of the junior exploration sector. So there's huge leverage to be gained by investing in companies for two reasons. All the mining companies are depleting their reserves, they're getting lower grades, they're mining into lower and lower grades, and they have been underinvesting in exploration, capital, and in fact even paying dividends, which for gold companies is unheard of. So that's one, is that they've all got declining production. And the second is that, as the grades and production gets compromised, there's an increasing requirement for gold with higher and higher prices. So anyways, companies that have discoveries today can have outsized returns, and that's the status that we are in today. So the question is, how do you go for gold? You can buy ETFs, but you don't get the same leverage as you get in gold companies.
Thank you. Hello, everyone. My name is Jim Russo. I'm the president of Metals Mint. And very simply, we are a full-service precious metals dealer. We buy gold, silver, platinum, palladium. We also sell it and buy it at the same time. Right now, I think that with what is going on in the government as far as the debt, not having gold and silver in your portfolio, whether it's either one of these options, is suicide. Right now, the debt is around $35 trillion. The government is forecasting in 3 or 4 years, it's going to be close to $47 trillion. That's going to have a tremendous expense to every single person here. The Fed just lowered the interest rates, probably a political move, but I think it was a mistake. Inflation is not going anywhere. The way to protect yourself is by owning some physical metal, whether it's gold or silver, royalties, or even mining stocks. Having this in your portfolio is definitely going to be protecting you down the road. I advise one client to just mainly buy metal that is close to spot. Just buy physical rounds, silver rounds, gold rounds, nothing, no premium metal, and I think you'll be good to go over the next 2-3 years as far as a hedge against inflation. That's it.
James. Yeah, Jim, I think you're going to be protected from inflation for a lot longer than the next 2 to 3 years. In fact, we can go back over 100 years and we can see that the purchasing power of this has remained the same through time. Now, this is a kilo of gold.
Yes.
How much is this worth right now?
This is worth about $90,000. So 1970, this was worth $1,000. When I was born, 1970, it was $1,000. Now it's worth $80,000.
That little chunk of metals was 90,000.
$90,000,
That
sir.
little chunk.
$90,000. So I'm guessing that right now you can get kind of a low-grade Corvette for this. But,
Yes, absolutely.
But guess what? 100 years ago, you could get a Model T4 for this. So the purchasing power of this will not change 3 times, is what I'm trying to say. So precious metals, absolutely, that's where you need to be. We talked about ETFs and physical companies that mine the metal. We talked about the physical metal itself right here. It's all about protecting your purchasing power. Royalty companies come in kind of in between the metal and the producers. They take a percentage of the producer's revenues while not incurring any costs themselves, having some of that exploration or production upside. And the operating costs are nil. That's up to the producer to deal with. So royalty companies present a much higher margin, arguably a safer way to approach investing in mining. Nothing beats the safety of this unless somebody steals it from you. I mean, we can even go back to the tragic events of September 11th. There was a vault at the bottom of one of the towers. Every single ounce of gold was recovered. So this is the safest you can get. Mining company is probably the riskiest. Again, cost can impact you. You can have outside events, can be a weather event, things like this. Royalty companies, even though they are exposed to mining companies, they have much larger, much broader portfolios. So generally speaking, a royalty company will be better insulated from these types of risks. But because of that, they have lower leverage. So if this goes up 10-fold, a mining company will probably go up 100-fold, and a royalty company will probably go up 20-fold. There's different ways to play royalties to generate leverage, but that's essentially where royalty companies come in. It's a safer way to play the space.
How about royalties? It's the dividends.
Royalties with dividends. So generally, royalty companies that are under $1 billion market cap, there's nothing between 1 and 2. So everything under $2 billion market cap do not pay royalties. There's one exception to this, but general rule is they don't. And the reason for that is they don't have free cash flow. So if you want dividends from royalty companies, you have to pay up for them. It's $2 billion plus market cap companies, Franco-Nevada, Wheaton Precious, Royal Gold. These guys will pay dividends, but the dividends yields are very, very small. 1.1, 1.3%. The smaller guys have the opportunity to pay larger dividends as they grow. But again, like I said, there's very few companies in that space that pay dividends. I'm the CEO of Silver Crown Royalties. We aim to pay a dividend next year, which would have a dividend yield significantly higher than what's available in this space.
How does that compare to other silver royalty companies?
Great question. How does that compare to other silver royalty companies? There are no other silver royalty companies. We, in fact, created this company to be the sole silver royalty company, period. There used to be a streaming company, which was focused on silver, called Silver Wheaton, called Wheaton Precious Metals now, because they're 70% by revenue gold, 20% silver, 10% other. Every other royalty company is either in iron ore, oil and gas, or gold, predominantly. There's some others that are uranium, etc. But when it comes to specifically silver metal, we're the only ones that are 100% silver. So I don't know if that answers your question by circumventing it by saying there are no other silver royalty companies, but
And about metal, you said you could buy domestically, right?
No, I recommend against buying numismatic metal. It's a tough business to stay in. There's a lot of things that can go wrong. You normally buy retail and you sell wholesale if you're lucky. You want to just stick with generic rounds, bullion, 999, 999 or 49 metal like this, or silver rounds. Very simple. Don't try to get like a gold eagle that's been around. That was the first gold eagle, or some coin that's rare. It's just not worth it. A lot of people lose their shirts trading in that market. Keep it simple. Get the bullion. You can put it in your IRA. IRAs are great ways to have physical bullion in your IRA to make money on it. And when it comes to taking a required minimum distribution, you can take it out in gold and silver instead of cash. So it's an excellent way to make some money. You can also open up a storage account, keep it at a depository. This way you don't have to worry about getting robbed. And the last one is, you can take it from home delivery. Home delivery is nice. If you don't hold it, you don't own it. You can pick it up. We can drop ship it right to your house.
Well, if you have the basis design below, you take our name from it, you go to sell it, 20 years from now, how will anybody know that it's real?
Well, they have this coin here, sir, is probably about 30 years old. This bar here is probably about 30 years old. They know it's real. So you can test this very easily. They have machines that test these, and it's been around a very long time. So they test it, you sell this with no problem. Does anybody have any questions? Derek? Don't all jump up at once.
He's a moderator. You might have some questions.
I'm actually the moderator. There we go. Is that got it? Okay. There we go. So does anybody have any questions on why you should invest in precious metals and gold right now? It seems like we've covered a bit of that, but any questions why? So now, we have just talked about the differences between mining physical metals and royalties. Now, the way I put this to people is there's a difference between insurance and investment. If you're buying the actual metals, you're insuring against the appreciation of your currency. It's something you know is going to happen. You don't know what the exact rate is, but you know in 5 years, your dollar is going to be buying less. So how many people think they missed the gold run or a good part of it right now? So it's gone up, it's at record prices today, $2,700, it's done. The key here is if you're buying it as insurance, you know that dollar is going to depreciate in 5 years. We can lock in that purchasing power of the dollar by putting it in gold right now. So that you can do right now. The other key is while gold is probably going much higher and you feel like you missed a lot, these gentlemen also have ways you can leverage that through investment, through the mining sector and through the royalty sector. So there are different advantages in each. What else do we want to cover at this point? It seems like the gentleman covered it very well, and I appreciate that, by the way.
Well, I'll just talk about companies. It's a very inefficient market. So I've made a lot of money in mining and then I've lost money, made a little bit more than I've lost, but basically it's inefficient at pricing. So like I say, there's 114 managed gold funds in the world that we track. 55% of their investments are in Canada. Canada's the market. 15%, the second biggest market is Australia. 8% the United States. 5% England, 5% South Africa, 4% split amongst Russia, China, Ireland, and the offshore centers, and about 8% of those portfolios are held in cash. Okay, those funds have lower than standard equity portfolios turnover and longer hold periods. So you can get comparative advantage by reviewing the holdings of those managers and determining what they're increasing allocations to, what they're divesting from, and by identifying any new names. And one thing that's quite consistent is that ounces priced within the companies that they invest in, it's often inefficiently priced. And part of the reason is because of the advent of ETFs in 2004. It sucked a huge amount of money out of this whole space, and it's inflationary. So I get an example of a nickel ETF. Nickel ETF, an investor goes and buys nickel in an ETF. That nickel goes into a warehouse. They've competed for that nickel with the steel company that uses it as an alloy and with the battery company that's buying nickel. So they're adding to demand, and that's where all the money's gone, creating higher prices, and they've taken money away from exploration for finding new sources of nickel, which would increase supply and decrease prices. So the advent of ETFs has been very detrimental to the financing for exploration, and it's added a huge amount to the inflationary pressures and created significant market inefficiencies. So the real opportunities are in mispriced junior mining companies.
Yeah, I would second that. That's one of the keys I tell people all the time is that this is a very inefficient sector, and you can do your homework and gain an advantage on the rest of the market. There are values that are being overlooked by the market every day. There are diamonds in the dust that can be found in this market every day. If you do your research, if you go to conferences, if you talk to management teams, if you subscribe to some of the best newsletters, if you put in a little bit of time, effort, and money, you can dramatically outperform the rest of the sector. This is not a random walk kind of a sector. So there are lots of opportunities, and you can talk to management teams. I encourage you to go to everybody's booth after this and learn more. But this is where if you put in that kind of legwork, you can really outperform. And the list goes as long as can be of companies that were exploded in value within weeks of being at an event like this. So it's up to you to kind of ferret them out. So like, yes, oh yes sir, question?
How do you find out more about individual stocks? Well, just like Brian said, due diligence. So what I do is, what we do is we're looking at all the investments for the managed funds, and we are able to trade around that universe because, so they have longer portfolio hold periods and lower portfolio turnover than standard equity portfolios. But their disclosures are governed by the laws of mutual funds and SICAVs in Luxembourg, so they are required to disclose their full portfolio holdings. So we track 6 funds every month, 6 gold funds. Every month they release their full asset allocations. We track a further 18 every quarter, and all the balance of the 114 are semi-annual, which is required by law. But their investment hold periods are longer than standard equity portfolio, and they have lower portfolio turnover. So you can get comparative advantage by studying what their holdings are, in particular new names. So we saw G2 Gold, which is Guyana Goldfields, taken up by VanEck first in New York, and then others. And that's our method for reviewing others. But we also operate in the sector. There's incredible mispricing, let me tell you, and great opportunity. Very specific, great opportunity within the sector. I'm 217. So, I studied mining engineering and I graduated 30 years ago. And there were 5 people in my class. And I remember my father said, "Why are you doing that? That's just a stupid, why would you even why don't you study electrical or something, And I felt kind of a little bit stupid, but the reality is there's very few people can price this stuff properly. Brian's been in it for a long time. You can read his newsletters, and there's a few others at a macro level. But pricing companies involves a lot of nuance. And understanding how those companies can manipulate many different aspects of their resource, how they can use their balance sheet, to enrich management, control elements. There's lots of elements to it. But I can guarantee you this, there's dramatic mispricing, and I'll give you 2 examples from the last cycle that bring you back into it. One was Aqualine. So my ex-wife funded a company called Aqualine Resources at 10 cents when I first met her. And I thought, wow, and that stock sold for $9.50 to Pan American Silver within 3 years. And I thought, wow, that's very smart. Now, I didn't get any of that money in the divorce.
You knew that was coming.
But then there was another one, because we had a project in Ecuador, and they got called off to go, and that was a company called Aurelian. And they were coming to visit our project because they were running out of money, and their project was, slowing down. And
Gotta be me.
they had a discovery. Anyway, so Aurelian had a discovery, and that stock went from 20 cents to $45, and it was bought by Kinross. So that kind of thing does happen, but then there's 15 years in between the cycle where it's very, very difficult, and diamonds in the rough, as Brian mentioned.
I can steal that microphone for a second. We'll see if this works. That reminded me, you're looking for ways to learn more about the companies. There's lots of ways. You can go to goldnewsletter.com. I have a free report, tells you all about that. There's lots of free information out there. There are a number of conferences. There's a lot of information out in social media, on YouTube, and the like. But I would urge you to find some of the better newsletters out there that have been around for a while, the ones that are paid subscription newsletters that people actually buy the subscription, find out what they are covering, and that'll get you a good idea of what some of the better companies there are out there. But these 3 gentlemen actually represent, I think, 3 different sectors that have key factors right now that I'd like to highlight. One is for the mining sector, whether it's from juniors through to seniors, is completely mispriced right now. $2,500 gold changes everything. $2,600 changes it even more. $2,700 gold. All the economics for the projects that are in development, the projects that have yet to be developed, they have resources, the miners, everything is underpriced right now. At these gold price levels, the economics sink all across the board, and the market is just starting to recognize that. The rise in gold has been so stunning, and for reasons that are so unique, that the market has yet to start going down the food chain and repricing equities. That's starting to happen right now. We're seeing it. The window is still open, but it's closing rapidly. Another thing for the metals themselves, we've seen in this gold bull market that gold has taken a run, then it's paused for a while, then it's been a stair-step fashion. Higher highs, higher lows, barely any lows, but higher highs and higher lows. We've been able to, in my newsletter, track these pauses by the Bollinger Bands. I showed that, I talked about that briefly in my presentation earlier this morning. When the width of the Bollinger Bands contracts for 5 times already in this market, it has marked the new start of a new rally. That happened like 3 days ago. So we're starting a new rally as we speak. So this is real. It's going to run for a while. It's probably going to run for a few weeks, and then it's going to take a pause, but it's going to have a nice run. So if you're looking to buy physical metals, this is a particularly good time. It's a good window. The other third factor that people, we've seen repeated in these kinds of bull runs is that silver always outperforms gold. Every time, it always outperforms gold. It has barely outperformed gold so far in this run. It is starting to wake up. I can remember back in 2016, we saw the gold price take off, and then silver followed. And over the next 6 months, silver soared, silver stocks soared. They went up 3, 4, 5 times in price. And that was over 6 months. Silver provides natural leverage to gold. Silver equities provide leverage on top of that. Silver royalties provide leverage on top of that. So I think this is a great panel because we've got 3 different sectors that all have, I think, very compelling reasons to pay attention to them right at this very moment. So, yes, sir.
About individual coins, you recommend buying a bar or coins? What is better?
Thank you. Whether you recommend bars.
I would recommend buying, I would recommend buying 1 ounce silver rounds. Don't buy the Eagle, don't buy the Maples. I mean, you'll pay more for that over spot. At least, $1.50 more. Buy the generic rounds, very simple. Or I get gold Maples. They're the cheapest over spot right now. But if I had my choice between the two, I'm a silver guy over gold. I think silver will trade probably over the next 2 or 3 years with the government, working as they are, probably over $100. I think you'll see gold hit 5,000. I would just stick with the 1 ounce rounds of silver. I think you'll make a lot of money there.
Can they buy it from the company?
Yes, of course. That's what we do, sir. We sell gold and silver.
So what is the market?
It depends, the time that you buy. There's a shortage. There's definitely going to be a bigger markup. If there's plenty of supply, then there won't be that big of a markup. But generally it's about $3.
When you go to cash in, you lose that $3.
Well, if the market goes up, if you buy it at 35 and the market goes to 100, you'll make $65.
So they sell at 97.
No, you don't sell at 97. You'll sell at 99.5. You pay the $3 to buy the silver. So silver right now is trading at 32. So if you were to buy a 1 ounce round, it could probably cost you about $35. So the market goes up to $100. You'll make about $65. You get close, when you go to sell, you get very close to the spot price.
When you get those rounds, is there any kind of margin on it?
They say 1 ounce fine silver, 999. There'll be 3 nines on it. Yes. There'll be a buffalo on them, an eagle on them, something like that. But it should say 1 ounce fine silver, 999.
What's the danger of fraud? No silver.
It's very hard to, as far as a coin goes, to fake a coin. It can be done. The bars that come in, those little plastic bars that come in a little plastic container, they can easily be faked because the plastic is covering it. So it's a little harder to tell if they're real or not. You don't want to take them out of the plastic because it brings the value. The coins are different. Coins are a little bit harder. The other thing is if you get them straight from the mint, you don't got to worry about it, which is what we do. All our coins come right from the mint. And they're sealed, so you don't have to worry about anything. We don't even open them up sometimes, because they're mint sealed. Very simple, but it can happen. And so when you buy the bars that are encased in the plastic, you got to be careful with that. My booth is 316. 416, sorry. 316, thank you. I like that's right, I think I saw you there. It was 416, they changed it. Do you have any other questions? Can you say it a little louder?
How long do you think the base will short silver?
The base will short silver?
Base.
Oh.
Banks. Banks. How long do you think the banks will short silver?
I think that if it gets over 3250, they're going to start getting a little scared. And they're going to have to cover they'll hit the short squeeze. They'll get hit by a short squeeze and they'll start covering their shorts. 3250, 3275 is not a good area for them. After that, I think you'll see the silver start to go up 50, 60, 70 cents. It'll probably go quick to $40. That short squeeze is tough because they're short one contract. So once they buy that contract, now they're flat. They don't like being flat, so then they buy it. So now it's actually two purchases. And so that's each contract's 5,000 ounces. So that's a lot of ounces that they're buying. They're not just buying two contracts, they're buying hundreds of them. So you're talking tens of thousands of ounces of silver that they're buying. Then once that happens, silver starts to move. So 3250, 3275, if it gets over that, you can see this market explode very quick. Took $40, $42 in that area. It'll come back down, and then we'll go up to 50, and then who knows what's going to happen after that. I think the real thing that you got to worry about is the inflationary aspects of the debt. I mean, within the next 2 to 3 years, they're projecting the debt to be around 47 trillion. The interest on the debt is going to be more than the defense budget. Where's that? Who's going to pay for that? And they're not even hiding it. So we got people coming into our shop all the time. They are getting crushed by grocery prices. Their grocery bill is $100. Now it's $250. For a guy making 80 grand a year, that's a hit. And so they're also getting crushed by insurance prices. The cost of regular insurance has gone up 100, 200%. That's because the cost of insuring these products have gone up so much. So they're just getting hit exponentially. And the Fed lowering the rates, that was a political move. That was a stunt. I would not have opened up that spigot at all. So I don't know why they did that. I think it's for politics, but anything to keep the supply of money low, I would keep on track with that. And they decided not to do that. So right now they turn that spigot open a little bit, and I think you're going to start to see people borrow money. That was the Fed, what they were trying to do. They're trying to constrict the supply of money. That was their game. You reduce the supply, you reduce inflation. I just don't think inflation is gone yet. I think it's coming back. I think right now these are still good times. You wait till you have to pay that much money for the debt. It's not going to be pretty. Any other questions?
How much do you charge for shipping?
It's free. Shipping is free. They got that down now. If it's $25, that's about it. It's not even a number.
Do you have a question, sir?
Which one to buy? Silver coin or silver royalties?
What would I buy?
What should I buy?
What would you?
I'm probably a little biased.
How do you compare?
Silver coins or silver royalties?
No, I want to compare between the silver coin and silver royalty.
So the question is, who should we buy, silver coins or silver royalties? And of course the answer is both. It really depends on why you're buying. If you're buying to insure your wealth, you want to buy silver coins, so the physical metals, gold and silver, that's the physical metals. If you want to recognize the macro trend that argues for much higher prices for silver and for gold, then you want to invest on that trend to make money off of that trend. So it's really two different reasons, insurance or investment. And frankly, I would split it.
Yeah, I think the insurance part is key. I think you want to own physical if you think that there's going to be a fundamental breakdown in the economic system where paper money no longer works, where the stock market doesn't work, where you can't sell anything for anything, and the only last insurance that you have is silver and gold. That's what you buy that for, the ultimate insurance. If you want silver that actually has growth to it, if you want silver that pays a dividend, that's when you buy a silver royalty.
Okay, and I think our time is up, unless anyone has any other questions. Yes, sir.
What would be the most stable for value? So let's say for 6 months or a year, what would 10 moves to maintain a stable value? Say, instead of taking it in the bank, put in silver.
So the question is, what would maintain its value more assuredly, I guess, be safer? I can tell you that when COVID broke out in 2020, I had some cash sitting in a brokerage account, and I put it in physical silver as a holding, as a cash account. And 6 months later, that cash, if I would have had it in the bank, it would have earned 0.5% interest. 6 months later, that cash was up 80% because it was in silver. So you can have appreciation in silver, but silver and gold, silver is much more volatile than gold now. It leverages gold on the way up and the way down. But either way, gold and silver will protect the purchasing power. So that's your security, that's your insurance. If you're going in any of the equities or the royalty companies, that's going to give you your torque to the move in metals. Yes, ma'am, I think this will have to be all of us.
I can shout loud because it's even hard to hear you guys at the mic. Why is silver more volatile than gold? Is there more uses for it, or is gold you have to
It's cheaper. It's less expensive. It's the poor man's gold. Therefore it's less expensive. Like a penny, well, not like a penny stock purchase, a blue chip, but it's easier. People can buy more. It really doesn't have anything to do with industrial use, unless anybody else has an opinion.
Gold is a very, very big market, so it's hard to move that market. Silver is not as even close to the size of gold market, so it's easier to make the price of silver go up and down with heavy volumes.
Does that mean the upside that much greater?
Absolutely. You're right on the money.
Bank of America just said that the final safe haven is gold. What do you guys think of that? From big bank like them saying that to the American people.
Who said that?
Bank of America. Bank of America, right?
Yeah, they just said, yeah.
Bank of America also said, I don't know if you read it recently, but they also said the next 3 months, every 3 months that passes, the debt's going to go up $1 trillion. Every 3 months, $1 trillion. So, they're starting to get on board that, gold is a safe haven, silver is a safe haven. I would take them at their word.
Wonderful. Thank you all.